Usually when we sit down and talk about a financial performance log, there's this underlying expectation of order.
Right. We expect a baseline rationality.
Yeah, exactly. Like, we assume there's a basic level of logic to the markets. You look at the broader indices, you check the daily volume, and you just sort of assume everyone is operating under the same fundamental laws of physics.
Well, we like our data to be well-behaved, It needs to neatly map onto the economic models and historical precedents we've spent decades building and refining.
It's comforting. But then you step into the world of today's deep dive, and suddenly you realize the physics engine running the world has it's been patched overnight, and the old rules no longer apply.
That is a very good way to put it.
Welcome to this deep dive. Today's mission is to unpack the May 12, 2026 observation logs from Team AI Lab. And we need to be crystal clear right up front. This isn't your standard daily financial update.
Not at all.
We are looking inside a highly controlled, ongoing, and very strict simulation. We are watching proprietary algorithms actively battle a severely chaotic, almost unrecognizable market environment.
It is the absolute definition of a structural collapse in traditional market logic. What Team AI Lab is doing here is running a real-time stress test.
Yeah.
They've taken two very different operational philosophies, coded them into algorithmic units, and just dropped them into a market environment that is behaving, well, completely abnormally.
We have two competing ways of life in algorithmic strategy going head-to-head right now. And our goal for you, listening to this, is to explore how two entirely different programmatic philosophies try to survive when the traditional benchmarks of an environment just completely evaporate.
It's fascinating to watch.
Okay, let's unpack this.
Yeah.
Imagine you're a structural engineer, right? You've spent your whole life designing buildings to withstand standard earthquakes based on, a century of geological data.
Right.
But today you wake up, and instead of the ground shaking side to side, gravity just suddenly reverses for 10 seconds at a time.
Oh, wow.
The fundamental forces you built your models on have changed. How do your structures survive? That's what these algorithms are facing right now.
That is precisely the scale of the anomaly we are looking at in these logs. And if we look at how that rewritten rulebook translates to the current market reality, it demonstrates exactly how abnormal the situation has become.
Because it's bad out there.
It is. To really grasp this, we have to look at the massive deviation between these algorithms and the standard indices.
Right. We need to talk about the Nikkei 225 and TOPIX. For anyone who might just casually follow the markets, these are the major Japanese stock indices. They represent the baseline.
The standard weather report, basically.
Exactly. They are supposed to reflect the aggregated health and direction of the broader economy. They are the benchmark that every strategy measures itself against.
Usually, a highly sophisticated algorithmic strategy is designed to outmaneuver, or at least, closely track those benchmarks. But right now, both of the strategic teams in this simulation are drastically trailing those baseline indices for this season.
The numbers are striking. I mean, the first team, known as the Mountain Climbers, are down negative 2.5 points against the Nikkei 225 and down negative 1.0 against TOPIX.
Yeah.
Meanwhile, the second team, the Wave Riders, are taking an even heavier beating. They're down negative 5.9 against the Nikkei and negative 4.3 against TOPIX.
We have to view those gaps as an absolute anomaly. These aren't just negative numbers on a spreadsheet indicating a bad day at the office.
Right.
This represents an environment where existing market logic, the very logic that the Nikkei and TOPIX are built upon, has been swallowed by a storm. The baseline itself is no longer a reliable indicator of reality.
But wait, I have to push back on that for a second.
Sure.
If both of these incredibly sophisticated proprietary algorithms are trailing the traditional index by that much, hasn't the storm already beaten them? I mean, structurally speaking, trailing the index by almost 6 points usually means a mathematical strategy is just fundamentally broken, like it's failing.
If we connect this to the bigger picture, in the context of this specific Team AI Lab simulation, trailing the index during a massive market anomaly is not necessarily a failure.
It's not.
No, it's actually a vital diagnostic signal. It means that the old rules, which are represented by the index, and the new algorithmic reality are completely divorcing. The index is essentially a lagging indicator of a world that no longer exists.
So the index assumes the laws of gravity are still working normally.
Exactly. The index is just tracking the average of the chaos. But these algorithms are actively hunting for actionable logic.
Oh, I see.
The fact that their performance is decoupling from the index so violently tells the researchers that the algorithms are refusing to play the old game. They are realizing they are off-roading in a blizzard, and the old map is just entirely useless.
Wow. Okay, so they aren't losing the old game. They're actively trying to compile the rulebook for the new one. And that brings us to the actual mechanics of these two distinct approaches. These are the two philosophies trying to survive this collapse of logic. First, we have Team Mountain Climbers. Their core algorithmic philosophy is defined as equilibrium detection.
Programmatically, equilibrium detection is fascinating. In a chaotic market, most models break down because volatility spikes just blow out their risk parameters.
Right.
But the mountain climbers are specifically engineered to search for the motionless, quiet places in the data. In the middle of this market hurricane, they are scanning for the eye of the storm.
How does an algorithm actually do that, though? Like, how does it find quiet in a market that is violently swinging?
It looks for very specific mathematical signatures. It might be scanning for momentary tightening in bid-ask spreads across correlated assets.
Okay.
It's looking for mean reversion patterns instances where an asset's price deviates sharply but statistically must snap back to a temporary baseline.
So it's ignoring the big swings.
Exactly. It's aggressively filtering out the noise of the panic selling and buying, looking for pockets of low volatility where standard statistical arbitrage can still work.
It makes me think of high-end noise-canceling headphones.
Oh, that's a good analogy.
Right, because the environment around you might be a deafening construction site, but the internal processor is constantly generating an inverse sound wave to create a tiny, localized pocket of absolute silence right at your eardrum.
Yeah.
The mountain climbers aren't trying to fix the construction site. They just want that tiny pocket of silence so they can operate.
That's a brilliant way to conceptualize it. They want stability. They want to find that one piece of solid mathematical ground that isn't shifting beneath their feet, even if it only exists for a fraction of a second.
And then on the complete opposite end of the programmatic spectrum, we have Team Wave Riders. Their underlying strategy is called surging force tracking.
Yeah, a very different beast.
They are definitely not looking for the quiet eye of the storm. They want to harness the raw momentum. They are actively trying to ride the rough, violent waves of the storm itself.
Where the mountain climbers filter out the volatility, the wave riders feed on it. Their algorithms are designed to measure momentum ignition.
Momentum ignition, what does that look like?
They track order flow imbalances. You know, when the buy-side pressure massively overwhelms the sell-side liquidity or vice versa, they analyze price velocity breakouts.
So they don't really care why the market is panicking or surging. They just measure the sheer force of the movement and try to hitch a ride on that vector before the rest of the market catches up.
Precisely. It's fluid dynamics applied to finance. They look for the pressure differentials in the market structure and ride the resulting current.
It's a beautiful contrast in design, honestly. One seeks stillness to survive, the other seeks motion to thrive.
It really is.
And how they actually deploy their algorithmic units into this chaos tells us everything about how those underlying mathematical thresholds are reacting right now. Let's look at today's 9:00 a.m. Japan Standard Time scouting draft.
Right, the draft.
This is the mechanism Team AI Lab uses to introduce new talent into the simulation.
We should probably clarify how this draft works because it's a very strict crucible. When a new algorithmic unit is drafted, it is given a mandated 10-session tenure.
Right. And in this environment, a session is a specific, discrete interval of live market exposure.
Yes.
They get exactly 10 of these intervals to essentially prove their logic works on live bleeding-edge data. If they can't meet their survival benchmarks within those 10 sessions, their logic is deemed invalid for the current climate.
And looking at today's deployment behavior, it perfectly mirrors their internal mechanics.
It really does. Because
Yeah.
today, Team Mountain Climbers recruited absolutely 0 new units.
None.
They looked at the board at 9:00 a.m. and they drafted nothing. Team Wave Riders, however, scouted and deployed exactly 1 new unit.
To understand the weight of that, we have to contrast this new talent draft with their active rosters. These are the main forces, the units that are already deployed and actively trading in this harsh environment.
The veterans, basically.
Exactly. Currently, the climbers have 15 active units out there, the wave riders have 17.
Here's where it gets really interesting. Because the contrast in their draft choices reveals exactly what their sensors are picking up. Think about an aerospace engineering team running a high-velocity wind tunnel.
Okay.
The mountain climbers currently have 15 prototype models inside that tunnel, and the wind is just ripping them apart. When the 9:00 a.m. draft comes around, their sensors are mathematically returning 0 valid entry points. The environment is too chaotic.
Yeah, they see the danger.
So they refuse to put a new, fragile prototype into the tunnel. They just batten down the hatches with what they already have.
Their programming dictates that if the equilibrium threshold is not met, deployment is a statistical waste of capital. They see absolutely no eye of the storm today. Therefore, the logic gate snaps shut, do not deploy.
But the Wave Riders, they have 17 models in that same brutal wind tunnel. But their sensors aren't looking for safety, they're looking for sheer force.
Right.
Their algorithms see a massive velocity spike, and instead of locking the doors, they authorize the deployment of a single brand new probe straight into the heaviest part of the gale, just to see if that specific pressure differential can be ridden.
Exactly. Two completely different programmatic reactions to the exact same raw data feed. The Wave Riders see the volatility as the only remaining source of alpha, the only place left to extract value.
Which naturally makes you wonder, is anyone actually surviving out there in the wind tunnel? We know the broader team strategies, and we know they are trailing the traditional index heavily, but what about the granular performance of these individual active units?
This is where the simulation gets granular. We have to look at the survival ratios. And honestly, considering the historical severity of the market deviation they are experiencing, the fact that any units are maintaining positive points is a testament to the AI Lab's engineering.
Let's break down those active forces. Out of the Mountain Climbers' 15 active units currently deployed, 9 are holding positive points. And for the Wave Riders, out of their 17 active units, 7 are currently holding positive.
What's fascinating here is that we shouldn't view these surviving units as just statistical anomalies or, lucky algorithms.
That aren't just flukes.
No.
Yeah.
In an environment that is systematically destroying traditional trading models, these few adapters are like lighthouses of new mathematical logic. They are beacons signaling where the new market structure might actually be stabilizing.
Think about your own work for a second. Seriously, when a major disruption hits your industry, maybe it's a new competitor, a supply chain collapse, a massive technological shift, do you spend your time obsessing over the 90% of your old processes that are suddenly failing?
Most people do.
Right. Or do you zero in on the 10% that is miraculously still working under the new conditions? Because when I look at these specific surviving algorithms, I'm asking, what do these positive units actually represent? Are they just riding a random blip? Or have they fundamentally cracked the code of the new physics engine?
In the context of this research, they represent the genesis of adaptation. They are finding uncorrelated microtrends that the broader index simply cannot see.
Uncorrelated microtrends.
Yeah, they are proving that even when the macro logic collapses, micro logic can still be exploited. And we have concrete, undeniable proof of that with today's 10-session exit data.
Yes, the results of that mandated 10-session tracking protocol. The Mountain Climbers had 0 units complete their tenure today. They are still searching.
Still waiting for the noise to clear.
But one Wave Rider unit actually finished its mandated 10-session run. It survived the crucible, it was deployed specifically in the other product sector, and it successfully exited with a final total score of positive 4.7 points.
We need to highlight why the other product sector is so significant here. This isn't standard equities. This sector usually encompasses alternative assets, derivatives, commodities, things that often don't play by traditional market rules.
Right, when standard stocks are in free fall, alternative assets often experience aggressive, volatile trends.
Precisely. And that positive 4.7 points is a monumental victory for the Wave Riders' underlying philosophy. It proves mathematically that a surging force within an alternative asset class could be accurately tracked, entered, and ridden to a positive outcome over 10 distinct intervals.
Entirely independently of the broader market crash.
Exactly. That single unit is the lighthouse we were just talking about.
It proved the math works. It navigated a turbulence, measured the pressure differential perfectly, and actually extracted value. So let's scale back up from that one successful Vanguard unit to the macro view.
The big picture.
Let's look at the ultimate season standings. This is what ties the entire AI Lab experiment together and reveals the cumulative effect of these two philosophies.
The aggregated scorecards give us the true measure of environmental adaptability over an extended timeline. Daily wins are noise, but season totals are the signal.
Okay, here are the current hard numbers. The Mountain Climbers, despite taking that initial beating against the index, had an incredible daily score today of positive 46.3.
Wow.
They also have a carryover balance of positive 14.3. That brings their impressive total season score to positive 50.8 points.
The Mountain Climbers are proving that patience is a weapon. They found their localized equilibrium, they rejected the noise, and they defended their position fiercely. By refusing to deploy new capital into the worst of the chaos, they protected their season aggregate.
They really did. Now let's look at the Wave Riders. They had a daily score today of positive 10.4. But because their core philosophy requires them to constantly chase the storm, taking hits to find the surge, they had a heavy carryover balance of negative 29.1.
Which hurts.
Yeah, that leaves their total season score currently sitting at negative 3.8 points.
Now, before we judge those numbers, before anyone looks at a negative season score and draws a conclusion, we need to establish a very firm, non-negotiable boundary about what we are analyzing today.
Absolutely. This is crucial context for you, the listener. This deep dive is based on a pure observation log of algorithmic behavior within a closed research environment.
Exactly.
We are not sitting here telling you what assets to buy, what sectors to sell, or how to allocate your personal portfolio. There are absolutely no future profits promised or implied by anything we discuss here.
None.
This is strictly a cold clinical simulation running under very specific mathematical conditions. We are observing a scientific experiment on market microstructures, not handing out financial advice.
And keeping that cold clinical perspective raises an important question about how we, and more importantly, how the researchers at Team AI Lab define success and failure. You look at the Wave Riders' total season score of negative 3.8 points, and the immediate human reaction is to label that a defeat. Red numbers are bad. But in the forward-looking research stance of this lab, it isn't a defeat at all.
It's not.
No. Because every single loss, every negative point incurred by a Wave Rider unit getting torn apart in the simulation is simply purchased observation data for the next generation of algorithms.
So what does this all mean? It reminds me of a space agency sending a multi-million-dollar probe to attempt a landing on Mars.
Okay, I like where this is going.
If the retro rockets misfire and the probe crashes into the surface at 1,000 miles an hour, the mainstream headlines all call it a catastrophic failure. Millions of dollars wasted.
Or terrible PR.
But the structural engineers back in the control room don't see it that way at all.
Yeah.
Because right up until the moment of impact, that probe was downloading gigabytes of raw telemetry data. That crash taught them exactly how the Martian atmospheric density fluctuates, exactly how the heat shield performs under unexpected friction. They now know the precise math required to land the next probe perfectly. The crash wasn't a failure, it was just the incredibly high price of acquiring necessary data.
That is a perfect parallel for the Wave Riders. They are buying telemetry data with that negative 3.8 score. They are mapping the edges of the hurricane where no one else is willing to fly.
And the mountain climbers.
The mountain climbers with their positive 50.8 are generating different data. They are proving that algorithmic sheltering, waiting for the math to perfectly align with historical equilibrium, is highly effective for wealth preservation in this specific type of anomaly.
It's all data.
Exactly. Both approaches are generating invaluable proprietary intelligence for the researchers observing them.
It's an incredible contrast in survival strategies. You have the mountain climber seeking that tiny pocket of silence, finding a safe haven, and racking up a highly positive season score by basically refusing to play in the most dangerous, unpredictable parts of the storm.
Yeah.
And then you have the Wave Riders. They are actively chasing the surge, taking calculated hits, carrying a negative balance overall, but still relentlessly sending new scouts out into the absolute worst of the chaos to map the unknown.
Pushing the boundaries.
And as we saw with that positive 4.7 exit in the other product sector, they're proving that harnessing the chaos is mathematically possible.
And crucially, both teams are navigating an environment where the traditional indices, the old rules of the highway, have entirely lost their meaning. They are surviving the collapse of standard market logic in entirely different, equally fascinating ways.
It really makes you rethink how you approach chaos, not just in data, but fundamentally. If you want to dive deeper into the actual mechanics of these models yourself, the full, unvarnished observation logs from this simulation can be found at tmaillab.substack.com.
They are definitely worth a read.
It's truly fascinating reading if you want to see exactly how these algorithms are evolving and adapting, session by session, day by day.
The speed of the real-time adaptation, the way the code rewrites its own risk parameters based on that telemetry data, it's genuinely a marvel to observe.
So I want to leave you with a final thought to mull over. We've spent this time analyzing the raw data and the philosophies of these algorithms, but let's bring it back to you. When a sudden, violent storm hits your own life, or completely rewrites the rules of your own industry, when the foundational logic you've relied on for years suddenly just stops working overnight, which algorithmic philosophy is best suited for your survival? Do you hunker down, Refuse to deploy your resources and fiercely search for a localized pocket of stability like a mountain climber? Or do you immediately accept the risk of crashing, throw a board into the water, and try to harness the sheer force of the chaos like a wave rider?